Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday.
This week, we'll provide an update on traffic through the Strait of Hormuz and what that means for global energy prices. We'll also have a look at the difficult position that the Fed has found itself in at the moment and what that means for monetary policy over the year ahead. We're going to start off with the Strait of Hormuz. We track the number of tankers passing through the strait fairly closely as an indication of when we're likely to see energy supply normalizing. And lately, we've seen a pretty sizable decline again in the number of tankers passing through, suggesting that traffic through the strait is being throttled, and that does have some negative implications for global energy supply, given that about 20% of global energy supply is through the strait. In addition to that, we've seen quite sizable refining margins, the cost of turning crude into refined product like diesel and gasoline. And the net result of that is that while oil at the moment is sitting at about $80 per barrel there and thereabouts, because refining margins are so high, gasoline prices in the US and in other countries are still pretty elevated. And this implies that we're unlikely to see inflation come down as a result of lower gasoline prices anytime soon. In fact, for this month, we expect that gasoline prices will still add a little bit to inflation. Just having a look at the federal interest bill picture before we come back to the Fed. The interest bill for the US government continues to grind higher on an annualized basis. That at the moment is sitting at just above $1.2 trillion, which equates to about 18.5% of US government revenue. And that number is expected to continue to grind higher over the coming few years, according to the Congressional Budget Office. And as a result of that and increased competition for capital, we have seen bond yields move up across the globe and in the US in particular. Now, as a result of this, we've seen that the US Treasury has shortened the duration of its bond portfolio, now sitting with about 20% of bonds in T-bills. And as a result, Treasury would quite like the Fed to be able to cut rates some point soon. Now we're going to come back to the Fed. The Fed would be looking at a combination of factors, but primarily a combination of employment and inflation. And the latest employment numbers have been pretty weak. We saw that non-farm payrolls a couple of weeks ago missed expectations quite materially. In fact, they were down 23,000 year on year. The 3-month average has come down quite materially too. And so we are seeing quite a bit of data now, and we'll talk about some of the other data points too, that suggests that the US labor market is softening. In addition, the prior 2 months were revised down by a collective just over 100,000 jobs, suggesting that the current number may well be revised too. And so while the numbers look weak, they may well look weaker too over the coming few months. And importantly, wage growth has trended down as well, now sitting at 3.2%. So wage growth in the US actually now at this point is below inflation. You can see again how this has trended down over the past few months. This is important because it suggests from the Fed's perspective that inflation is not being driven by demand. In fact, wage growth, as mentioned, is below inflation. Inflation is being driven at the moment by a supply shock, the shock to energy prices and the very high refining margins that we're seeing globally. Switching to inflation, the other thing that the Fed would be looking at, inflation ticked down, sitting at 3.4%, down from 3.5%. That was in line with forecast. It is important to note that monthly inflation has been very volatile over the past few months, driven in the main by volatility in energy prices. And we've got a model which we use to forecast short-term moves in inflation. And given the sizable month-on-month increases that we had a couple of months ago, we would need to see month-on-month inflation in the US at about 0% or lower to get US inflation down to 2% by year end, which we think is very unlikely. So it's more likely that we're going to be in an environment where US inflation remains above 2% for the foreseeable future. And when you combine that with inflation expectations that are still fairly elevated, running at about 3.5%, the net result is that the Fed puts itself in a difficult position. We've got inflation, which is running above target, even though it's been coming down. Core inflation is at 2.5, above the target of 2. And in the background, you've got a labor market that's weakening and a US Treasury position that clearly would be in favor of cuts. It means that the path is not at all clear for the Fed, and they're unlikely to do anything in the interim, but there is a non-negligible risk that they hike over the coming 6 months, given still elevated inflation and still elevated inflation expectations, which of course would not all be helpful for the weakening labor market and not all be helpful for the US fiscal position either. We think this is going to be a key story in markets over the coming few months, and we will update accordingly. And finally, on China, we've spoken before about a range of indicators that suggest that Chinese growth is slowing, and we did actually see a GDP print which confirmed that thesis. The latest data suggests that China is likely to slow even further. The key leading indicator for the Chinese economy, in our view, is a series called Total Social Finance. It's been down year on year for some time, and that was one of the key reasons we expected China to slow, and it's still down. The 3-month average is down 10% year on year. If you look at money supply, it's also decelerating in China, and all put together suggests that the Chinese authorities are still finding it quite difficult to spur domestic demand. Exports have been very strong, but domestic demand has been very weak. In addition to that, unlike the rest of the world, where we've seen those bond yields ramp up, Chinese bond yields remain still quite low. There is space for stimulus, but we think there's not appetite for stimulus. And as a result, we are concerned around the near-term outlook for Chinese GDP growth. And that's where we're going to leave it for this week.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that are referenced in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity, Equity Derivatives, Currency Derivatives, Bond Derivatives, and Interest Rate Derivatives markets, an authorized financial services provider and a registered credit provider.